Hey, this is Sasha, and thanks for joining me here for another episode of Let's Talk Stocks, episode number 164. Now, in this video, we're going to be focusing on option leaps, long-term investment strategies to make more with less money. So our key focus in this video is all about options. It's about taking your capital, using options for longer-term investments. Can you still use some of these strategies and concepts I share with you on a shorter time frame? Absolutely, because of the power of leaps. Now, you'll have a few disadvantages, which I'll talk about in the video, but the goal here is if you're trading or investing in stock only at the moment and you're holding things for 6 months, a year, 2, 3 years, I'm going to show you how to do that with less capital by trading options or option leaps. Now, you might be wondering, what are leaps? And leaps are long-term equity anticipation security. That's what the definition stands for as far as abbreviation goes. But really what it comes down to is it's just a long-term option. Okay, it's holding things long-term. Now, what does long-term really mean? Long-term can mean 6 months, a year, 2 years, 5 years. The standard definition is typically longer than a year. But in my case in point is something less than 60 days because anything beyond that, you're looking at longer term holds, at least when we talk about options. So let me first share with you some disadvantages behind this, then we'll talk about some advantages, and then we'll actually look at some spreads and setting up some things and some pros and cons behind them. So some disadvantages to trading option leaps is that the higher total costs, you're going to pay more because there's more time premium baked in. Change in price makes you less money, which is another disadvantage because you usually have a smaller delta. In addition, when you really look at the setup of the spread, the volatility can also impact this. So that actual change in price usually makes you a little bit less money. It's not something that I worry about too much because you can tweak these options to where your delta is a little bit more in favor of what you're looking for. But in general, the change in price makes you a little bit less than if you just buy an outright stock. The bid-ask spread can also be a problem because you're going further out, so they can be a little bit wider. So you may need to play around on getting into these positions. You don't have to get into these positions right away. You could get into them 1, 2, 3 days later, 4 days later, because you're looking for longer term holds. And also, the volatility can shift and create an issue with the position. So this could be in volatility inversion, meaning you're on the wrong side of volatility because options are priced in part due to volatility. So if you get in on a spread and the volatility goes against you, even though the price is going in your favor, but volatility is going against you, you're actually losing a little bit of money. And again, there's ways to counteract that as you get more into advanced option strategies and you learn more about options. Now, let's look at some advantages. When we look at the advantages, it's a lower cost for the time you hold. So if you have less capital, let's say $5,000, $10,000, $50,000, again, lower really is relative depending on what you think is lower, but it's lower cost than if you bought the stock outright. It's a lower cost for your position size to hold onto that trade than it would for just B for regular stock. So in either case, you get to make the same amount, if not more, with less capital. That's usually a good thing. Now, of course, there can be a problem with that because now you're leveraging things up. There is less time decay when it comes to going further out. If you're looking at buying single option contracts or you're looking for certain movements in time, or if you've been burned with time premium in the past with options. So there's less time decay. That could be a good thing or a bad thing depending on the type of option trader that you are. If you're looking to capitalize for time decay, well, you know, it's not a good thing, but you can still make some time decay from it. But if you're looking for movement and you need it to move, you don't really have as much time decay. It doesn't work against you, but you can set it up to where it works for you. There's a longer life for the strategy to work, which is why there's less time decay. Because there's less time decay, you get a longer lifeline for things to work out in your favor. Now, you can still make money from time decay when you're trading option leaps or longer term options. It's just that usually you don't make as much. So basically, you can use option leaps in all sorts of ways. You can use them to make some money from time decay. It can reduce your risk in the sense of using less of your capital to make more money, or you could just use less of your capital to make the same amount. Now, do you really have to hold things all the way till expiration, let's say a year, 2, 3 years later? No, you don't. You could hold the trade for a month. You could hold it for a day or two. It's really up to you depending on how long you hold the trade. However, keep in mind that there's also some problems that can occur, like the volatility problem, that it could put you on a little bit on the wrong side of the trade. For normally, if you're looking to hold stock for a year or 2 years and it's not making you money, you'll probably get out. Now, yes, it makes you dividends. With option leaps, again, if you're holding it for 6 months, a year, it's not making you money. Now, you don't get the dividends, but you make a little bit on time decay, or you can. So let me show you on screen some strategies with option leaps, how to set them up and what you're really looking for. And that way you can see how you make money with this. Rather than trading the stock, you could basically trade option leaps and hold on to stocks for multiple years without even getting into the stock. Of course, you don't make those dividends if you're a dividend kind of investor, but you can make money from the time decay. So it really is a juggling effect depending on what pros and cons or what you're looking for, your risk levels and your risk tolerance. So anyways, let's go to the screen. Now, the first thing I'd like to look at is some single options. Okay, let's look and evaluate some time decay based on single option contracts, because this will really show you the bigger picture of the time decay process or the time decay issues, which is usually where people struggle with option leaps and with options. And it gives you the bigger sense of really what happens with options when you're looking at a longer time frame. All right, so here we are on screen, and what I'd like to do for you is just to share with you some insight on a stock. Typically, you could do this with anything that trades options, but I like to prefer to do that with stocks over $40, $50, even $100, because there's more time premium baked in. So if we go on screen here and we take a look at, let's see what we have here. Let's go into Amazon, which is a very big stock. And this is exactly why I want to go into Amazon. If you go and take a look at Amazon, we'll go ahead and we'll buy, let's say 100 shares of stock. You're looking at a price of 1,161. When you do this and you go ahead and look for putting that trade on, it's going to cost you around $116,000. Okay, that's kind of the total for your trade. If we look at analyzing this trade, you can see that basically using about $100,000 for a delta of 100. That means for every dollar move, the stock goes up, you make $100. Okay, if it gets to 1170, you make about $900. And I'm doing this based on the mouse movement right there. As I move the mouse up and down, you can see the profit and the loss. Okay, so let's leave this kind of in our queue. Okay, now if we go into an option contract, let's say we go 40 days out, and I'm looking for an option contract around $1,300 as the strike price. Go ahead, buy a single, analyze this trade. Keep in mind, time decay is an issue and a problem when you're doing single contracts. And now you're risking about $305 at expiration. That's the amount you're risking. You need the stock to move a couple hundred points before expiration, and you could make, $3,000, $4,000, of course, if it moves quick, even $1,000 or $2,000 at expiration. But it needs to really move. That stock has to move. So as we look here on this panel, and we start looking and evaluating right here, this contract, that's one contract, 100 shares. I only have a delta of 7. So when you compare this to stock, you have a delta of 100, whereas with an individual, you have a delta of 7. Can you increase the delta? Absolutely. You could get a little bit closer. 1270, let's say, will give you 12 delta. If you go in even tighter or closer to the current price, now you got a 26 delta. If I go to 1210, I got a 30 delta. And now, though, I'm risking about $1,695. So not quite $100,000, but pretty much it's still a decent amount for a lot of people out there, and you know, living off of a few $1,000s a month, this could be a lot of money. Now, if we're trying to match up the same delta here, and we go to 100 delta, let me make this about 25 delta. Let's see if I could get it around there. Okay, 26 delta is about as close as I could get. I'll need to trade about 4 of these to get 100 delta, and now I'm risking $5,620 to potentially make, let's say we go to 1,300, okay? 1,300, I can make $26,000, almost $27,000. If it happens right away today, I'd make 31. 26,000 is at expiration, okay? If I compare this to the stock and I look at it this way, $1,300 will make me, or at $1,300 on the strike price, will make me $13,000, almost $14,000. So as we do some calculations, and you bring up the calculator, 14,000, right? We're making about 14,000 on about 120,000 in capital, right? So that's kind of the stock way. Here, we make about 30,000 on, or 26,000 on about 5,000 in capital. So which one's bigger, right? You're risking 5,000 to make potentially, let's say 25,000, or you're risking 130,000 to potentially make about 14,000, to make half of what's on the option. So you can see the power behind it. Now, of course, the big issue you're going to be saying is that, Sasha, well, this option contract's going to expire because every single day it costs you about $128. Costs you about $128 because of the theta. So you lose money every single day this stands still. So let's say today you're down 128. Tomorrow, again, you're down another 128. The next day, you're down 128. And this only continues to accelerate, right? It ramps up. It's not 128. It then becomes 135. You can see right there, because we're only out about 40 days. So again, continue to increase the date, and you're almost down $3,000 out of your $5.5 grand. You're almost down half on your capital. Whereas with a stock, you could hold it for a long time, right? So what do you do in this case? Well, this is where option leaps come into play, and this is the power behind them. So if I go ahead and look and close down all these contracts, you can see you can get as far into options here in June, July, September, January. You can get the next year, and it's 500 days, 400 days out, 700 days out. So you could get out quite a bit in terms of time. So let's say we're going till September 2018, which gives me about 288 days. That's quite a long time. And here, when we look at the option strike prices right here, we could still do 1,300. It's going to cost you a lot more because look at this. It's $63 per contract, whereas the 40-day premium, or the 40 days out, is going to only be $2 a contract, right? Because there's so much more time premium baked in. So let me show you what that looks like. So if we go ahead and analyze the trade, and let's go to September. Okay, look at the price difference, 94 versus 13. That's huge. So here, when we look at it, 4 contracts cost me $5,300 for the January 18, which is only about 40 days out. Here, if we go into a leap, it's going to cost me about $37,000. So a lot more money, but it's still not $116,000 as you would be with a stock. Now keep in mind our delta is actually much higher. The delta here that we have is 191. So you don't need as much contracts. So we can actually just do 2 contracts to get the 100 delta. And that'll put us only at $18,000 in capital that we need. So still more capital, about 18,000, 19,000 capital compared to $5,000 in capital. So about 3.5, 3.2 times more in capital. But again, if you look at now your delta, it's still roughly about 100, but your theta drops to 41. Okay, so you're still losing money. You're losing $41 per every day, but it's not $128 every single day. So you get to save more money by holding these a little bit longer. So again, if the stock gets to 1,300 now, okay, what's going to be your profit? You're looking at about $16,000 in profit. You're not going to make as much as the 40 days out, simply because of the delta effect, the contracts, the volatility, all those things, and you're using more capital, but you have less time premium risk. Okay, so I hope that makes sense for you. Now, here's where things get really great, is as you start getting into verticals, this is where the power becomes with options. So let's get rid of all this nonsense, I guess, singles, because most option traders do not trade singles. Singles usually are for very fast trading. You're just holding it for a day or two, a couple days at most. Let's look at vertical spreads. So let's say I'm going to buy a vertical. So on a vertical, I'll just go ahead and let's say I'll buy a vertical, analyze the trade. Again, we're 43 days out on this one. And what we'll want to do here is we'll go and let's just say we still project somewhere around 1,300, but I'll go ahead and do the vertical something like this, okay? So this puts me current prices at 1160. The vertical is at basically 1250 and 1220. Let's actually make it 1,300 just because that's what we're looking for. That's what we were talking about. Let's say 50-point difference. Okay, here's the nice thing about verticals is you reduce that time value, time premium. Again, you're down to 10. Now the delta is only 9. So if I want to bump that up to, let's say, about 100, okay, I'm using, the capital I'm using is still around $5,000, right? Now my potential here is $50,000, but I need the stock to move. Now here, your theta is still around 113. Okay, so 113 per day. So you're still losing money per day on this vertical. So it's not a huge big difference on the stock if we look at the previous option contracts, right? If we go to, let's say, the 1220, you buy a single, you analyze the trade, and you compare this, you're still, and we go to 4, you're still losing 130 on the singles, and you're losing 113 on the vertical. So what's the big advantage to this though? Well, you lose a little bit less, but as this gets in your favor right here, because you have a delta that actually picks up and a theta that's actually works positive for you. So here, okay, what you're doing is as that time value continues, you can see that white line, which is the current line or today's line, gets closer and closer to the green line. Okay, and the green line is the line at expiration. So even as long as you're in 1,300 or 1,301 and this expires, so let's say you are at 1,301 at expiration, you go ahead and you make your full amount. You make your $50,000 on $5,000 of capital. Okay, if it's like $1,800, $2,000 a share, $2,300, you don't make any more than that. You still make your $50,000. However, if you look at the single right here, of course, if it goes up to $1,800, you're going to make a lot more, $220,000. Now for me, I don't really believe or trust my stocks that much. I care more about my cash than the stock because I'm not running the business there. So in this case, I don't really think stocks are going to explode to the moon all the time. I think they're going to move, but I don't think they're going to move to an extreme level. So a basic level right here is why we cap it, because this reduces our risk on the time decay and the theta. And then the theta then becomes positive as we get into that favorable more position. Now, could I go ahead and sell put verticals instead? Absolutely. I could actually go ahead and sell put verticals and be more positive theta. That's another approach. But keep in mind that we're still in January and we still have that time decay, right? So if I go ahead and go into actually take this to September that we talked about, and this may not be fully traded. Let me see which contracts are traded in September, because sometimes the strike prices are a little bit different. So we'll go in batches of 20, it looks like. So here we'll might need to drop this to 40 and 1300. So now, if we look at this, we bring the date back to today, we bring the price back to our price, and our delta is right at 100. I'm using about $27,000 in capital. Again, as you go further out in leaps, you're using more capital because there's more time premium baked in. But look at my theta. It's only 16 per day, rather than 130 on the other one, on the single. When you look at the single, 130 or 113 on the other shorter term vertical. Now you're down to 16. So it reduces that theta even more so. And you still have your 100 delta. Again, you're capping because it's a vertical on your profits. But as it gets above 1300, you're good, because then you could wait and you make your $50,856. So in either case, you make almost twice your money by holding it on. But keep in mind, you have to hold on to that position for a much longer period of time. Can you make more with a shorter term option? Yes, but the time risk is against you. You don't have, you can use less capital, but you have less time. And this is why for longer term investors, if you're looking for longer term, if you're looking for making money with the theta, because once it gets into here, right, let's say that stock gets into here. Now my theta is positive, it's 13. So as I continue to move this date, it becomes 14. We get into February, March, April. We get into 30 per day. Then we get into June, you're up at $60 per day on the theta. We get into July, August, you're up to 133 theta per day. That's from time decay. So imagine you're getting $133 per day from that option contract, which is probably going to be way better than a dividend on the amount of shares that you could buy for $27,000. So that's kind of the power behind it, is that you're basically making $27,000 on $27,000 by June or July with using a lot less capital and risking less on the time premium. So that's one good way of looking at it, and you can see that you can hold on to the stock for a long period of time without having that option time value problem. Can I get into this, use $27,000, and let's say this stock starts to wiggle around a little bit, and I'm starting to lose money on theta, and I'm down about, let's say, $300. I could just get out of it right then and there and say, hey, something doesn't look right, it's starting to sell off, and I'm out. That's another approach you could take. Now, if you're a longer term investor, you probably don't do that. So again, in this case, you could have a much wider pullback to 1,100, or even 1,000, and then allow that stock to continue to run in your favor because you have time. You have the time value. Now, you might not be so hot or interested in the fact that you're still losing money on theta, but what you could do is you can convert this vertical that you're getting into the calls. You could go ahead and sell the puts. So you could go ahead and sell, let's say you sell a vertical here on the put side, and now you'll be positive on the premium. Actually, let's go into the Januaries, so that way you can see the Januaries of how they work. Now, you'll need to trade more contracts on this because you're already in a favorable position. So as you get into, let's say, 9.50 and let's say 9.10, your delta is 43 cents. It's not a lot. Let's bring it in a little bit tighter. Let's say 1,100 or 1,000, and here's 9.90. We'll go to 10.20. Even then, your delta is 14. So as I bump this up, I'll still need to trade about 7 contracts. But here's the advantage to this, is that if this stands still, now I'm selling a vertical. If this stands still, I make money every single day, about $100, even if it stands still or it moves down a little bit. But I only make $6,209. So you don't make as much because you're already in a favorable position, right? Less risk, but you're in a favorable position. Less risk, less reward. So $6,200 is what you make, but you got to risk about $50,000. So do you want to use more capital and have no time decay, where time decay works in your favor? Or do you want to use less capital, but time decay works against you? Now, you could do a split position here, and you could do something along the lines of getting somewhere in the middle, which I'm going to show you in a second. But let me just go back to this vertical. Sell the vertical, let's say here. And let's take this out to September, right? So as we get into September, even if you're in a favorable position here in September, let's go till the 20s and the 80s. You're still in a favorable position. Now, in this case, you're using less capital, right? You're using maybe only 4,000 in capital to potentially make 2,000. Let's bump it up so our delta is still 100, or right around 100. But the problem is when you go further out, remember, time decay doesn't help you as much. It actually is in your favor if you're a buyer of option, but here you're a seller of options. So you only make 18 on the theta, but you're still in a favorable position, right? You could have that stock going down. So you could still do leaps. In this case, you don't make as much still. You're still using about 50,000 in capital, but that time decay works in your favor, and you could make still $24,000 as long as that stock's above the 1080 level at expiration. So if you're looking for long term, well, this could be long term. Again, you're making $17 a day, just like a dividend, still using about 50,000 in capital to potentially make about $24,000. And you can see how this continues to can move in your favor, because normally for long-term investing, you're bullish, right? Now you can do the same thing with splitting things. If you're a little bit more, hey, let me balance the time decay versus the risk. So again, let's do a vertical. And now what I'll do is I'll split it right in the middle of where the current price is. So we'll do kind of 11.10, and let's say 11.20, because those are not traded, and 11.80. So you can see I'm right in the middle. So now if I want that 100 delta, bump up the contracts, okay? Now I'm a 50-50 vertical. So I'm risking about 40,000 to make about 40,000, $37,271. Now here you could see my time decay though, because I'm almost right in the middle on that center peak, my time decay is nil. So now I still need the stock to move in my favor with time, but I have till September for it to do that. If I did this with contracts that are more recent, let's say in January, well, the issue here is is now the time decay. At the moment, it works in my favor, but if this drops down, you can see I'm losing 190 right away. Whereas on September's, if this drops down, you're only losing $9 every day. So again, time decay works in your favor, but it doesn't help you much if it moves in your favor. You only make $11 a day on the September's. And then on the January's, you would make $156, right? You'd make more in January's because the time decay is going quicker in the current month. So trade-offs, where do you want to be? Now, this is kind of tomato depending on your risk to reward. There's one last kind of strategy I want to show you, again, with a long-term leaps when it comes to options. And if we go here, it's called a diagonal, and you typically buy a diagonal. It's kind of similar to a calendar, but it's a diagonal, which a calendar is the same exact strike prices, right? The same exact strikes. So if we go to buying the Februaries and selling the Januaries, you can see that there is my calendar. And if I go to 1250 to, let's say, 1300, those are not traded. So let's see, 1260. So there we go. So you can see this is kind of a bullish position. As I look at this, this is a bullish position, right? You still want the stock to go in your favor. You're risking about $1,700 in capital to potentially make $2,000 in capital. If you want the delta to be about 100, again, we'll do about 7 contracts. So now you have time decay that works against you initially, but what happens is as it moves in your favor, time decay will slowly become more favorable actually for you. So in this case, what's happening is you're still risking about 11,000 to potentially at the peak make about 15,000. Now this is not necessarily the best approach because what can happen is it actually overshoots your stock and you're losing money. So it needs to land there at expiration. Can you take it off sooner? Yes, absolutely. And if you go to, let's say, the September's, let's go to see this further out. We have September and January. Okay, so if we go to September and we go into January 2019, oh, the other way around actually, January and September. So now what you can see is the time decay, the tent is actually wider as well, but the time decay also works in your favor, right? 18. So your spread is 1,100 to almost 1,500. It needs to land somewhere here at expiration. Whereas the other one, you only have the spread between 1,200 and almost 1,300. So you could see the spread is much, much wider. And here what you can do is the time decay, since it's working in your favor, well, it continues to get closer and closer to that green line. So as we get into March, April, you could see that time decay also builds. Now my delta here, as I started out with, was only 23 on 7 contracts. So you'll need to trade a little more if you continue to do calendar. Now here's the great thing about diagonal, is we can rotate it by trading less contracts. So instead of the 1260, which identically makes a calendar, I could go to, let's say, a 1240. And now you can see how it rotates a little bit, increases my delta. I go to 1230, you can see again, rotates, 1220, and my delta's picking up. I could go into 1190, I'm at a 55 delta now, and you can see how it's kind of like a vertical, right? It's starting to come into more like a vertical. Now, there's a lot of advantages, disadvantages, diagonals versus verticals. That's beyond the scope, but I'm trying to show you that for a long-term bullish investor, how you can still trade option leaps, and you can see how you can do it with this one by just skewing and adjusting some things, right? And the delta's close to 100, so I could increase the contracts right there, and now I'm at a positive theta. Okay, I'm risking about, let's say, $47,000 to potentially make $50,000, similar to a vertical. My theta is $14 a day at the moment. I do have a positive vega position in this case, whereas the vertical is usually a negative. When you're doing verticals, you need to, since you're in the same month, this can actually, though, work in your favor if the volatility picks up. So how can you really skew this and adjust it? Well, I could even move this back a little bit. And let's say I go to the 1090, and then I go drop this down to also the 1180. And you can see I basically moved it a little to the left. So now I'm in more of a safe zone. Now this reduces my delta a little bit, so I may need to trade a little more contracts if I wanted the same comparison. But you can see that even if it doesn't move, I make a good amount of money. If it moves up, I make money, not as much as if it stood where it was, because this descends a little bit. But even if it moves down a little bit, I'm still somewhat protected for about 100 points. So for long-term investors who are bullish because you're buying stock, this is again another approach. And when you go into diagonals, you could see how I could skew it and rotate it and really just shift that perspective from them rotating one way or the other. So let's go into a 1060 and you'll see the rotation. You can see that rotation happening. And it depends how much risk, how much risk to reward you want to play with. And this is really what it comes down to, is playing with these numbers and looking at these variations, the theta, the gamma, the vega, the delta, how many contracts you want to trade. So I could go ahead and trade less contracts, but I could rotate this much more and increase it by the rotation rather than the contracts. So that's kind of the power behind it when you look at some diagonals. And you still make money, kind of like a dividend, if this thing just stands still because you have that theta. And you make more later on as it gets closer and closer to that expiration. So as you get into 4 or 5 months later, you make $50 a day. And a lot of it could be just, well, you make $8,000 just from time decay on your capital. Of course, this does require around $40,000 in capital, but you're making quite a bit even if the stock doesn't move. For a longer term investor who normally trades dividends, or if you want to play the bigger stocks, this is how you do it. Anyways, I hope this gave you some insights to looking at leaps and the long-term way of how to structure them. Keep in mind, we just scratched the surface on options and leaps. If you really want to get in depth into options, you should really take a look at my course or some of the courses that I have on options on my website at rise2learn.com, or visit the tradersfly.com website, clicking some of these buttons on here. Sign up to the newsletter list so you get notified as I release new webinars and new material, new content, new books. Make sure you're on it, and that way you get some nice exclusive training, because they keep getting better, more in-depth, and more detailed. Now again, be patient when you're trading option leaps. They do have some great advantages if you're a long-term investor. If you're a small-term, shorter time frame investor, you can still trade them to reduce your time decay and time risk. So that's really the ultimate key with leaps, is you're looking longer out and you're reducing your time risk. There can be volatility consequences if the volatility shifts, because then you lose a little bit on the volatility side. But in most instances, if you're holding on positions for a longer time period, you shouldn't really have too much of a problem if you're structuring your risk to reward properly. Now, if you're just trading singles, that can be a problem. So, because you do have a lot of time value that really works against you. In either case, thank you so much for joining me, sticking with me, watching my videos, and investing your time with me. I know there's a lot of other videos that you could be watching right now, or even spending time with your family. But I really appreciate it, and I hope you're investing and getting a lot out of the material that I have to share for your own self and growing as a trader and an investor. Thanks again. Remember, sign up, check out the videos, hit some of these buttons, check out the courses, and I'll see you next time.